Today's video is a continuation, basically, of yesterday's video on what's going on with our pricing in the private credit. So when we think about this, what we really want to know is, did they know, right? Do they know what's going on? And then they didn't pay, they just did it anyhow, right? This is really what this is all about. And this is why, in my opinion, it's so dangerous. Now, look, this is for the industry, okay, private credit industry. And what this is saying is look, what percent of the holdings in the private credit funds are either below 80% of par, so below 80, between 80 and 97%, and above 97%. And we saw yesterday, and we'll look at it again, everything was basically over 97% for First Brand. But I want you to look, obviously, the industry at times has told us a totally different story about what's going on inside the issues that private credit is issuing, okay? And you can see at one time, only 30 some percent were 97% above par, and 59% were between 80 and 97. So if you follow this along and just look at what's going on here, all I would say is we know by the second or third quarter of 2023 that they already had the ruling that they couldn't force the private credit people to tell us the truth, okay? And this goes all the way, and if you look to the basically the third quarter of 2024, and this is when Trump gets elected, okay? And we now know what his SEC guy says, basically do whatever you want, okay? And so here we are in the first quarter of 2025 now, where we have 86% is 97% or better in pricing. And I don't even know if we can read it down there. What is it? 1% or 2% is below 80. Okay. So their pricing was determinate, or I shouldn't say pricing, their valuation of the issues that they have in their private credit were determinate by what they legally had to tell us. Okay. So we mentioned yesterday, here's the largest player. Notice who's number one and remember that, okay? And I want you to notice something here. We had this up yesterday. Here's all the private credit ETFs and what their performance has been. And notice number two, the highest with a positive return is Apollo, okay? The largest and the one with a positive return. So we just saw that chart on what they have to tell us about what the valuation of their paper is inside their portfolio. So this is coming from the private credit people, right? They're saying, hey, look at us, 97%, we're good, all right? But what does the market say? One of my favorite saying, people who follow this channel, is men propose, markets dispose, okay? So here you go. Everything is hunky-dory according to the industry, and yet the market has discounted every one of these private credit funds. So in other words, they may be saying, I'll make this up, Oaktree says that all in we're at 94.5% of par, and they're now selling 10 to 15% of the discount, okay? And so everyone has their different discount. And here's these other ones. And by the way, look at these dividend yields. So you say, why would someone buy this stuff? Well, this is why. They get 11.5%, selling at a 12% discount, no big deal, okay? But notice, The market is saying that they have BS numbers. Okay, it's obvious. Okay, so going back to the slide we saw, who was the only, well, there's no one barely positive, but who was one that was Apollo? Who was the one that was positive? It was Apollo. Okay. And so now people are looking in because we heard this right away that Apollo had shorted using CDSs, everyone thinks, the actual debt of First Brands. Okay. And now they're reporting from 9fin is that it was done by the structured financing arm of Apollo, Atlas SP, which gained access to information on part of First Brand's off balance sheet funding, which may have given Apollo insight into certain credit risks that the client faced. Okay. So you should stop and read this. It's very interesting. Okay. What is insider trading and so forth and so on. But they define it as buying or selling a security in breach of fiduciary duty, i.e., you know something, relationship of trust and confidence, again, you know something, on the basis of material, non public information. You know something that the public doesn't own. But the Supreme Court said, hey, guess what? Syndicated loans are not, in fact, securities and accordingly are not subject to state and federal laws and regulations. Wow. In other words, if it's a syndicated loan, there are no state and federal laws that are applicable to syndicated loans. What a business to be in. But the last sentence says they don't actually have these securities in the capital structure, so this specific angle would not arise. So you can stop and read this again. I encourage you to do this. Basically, we sign NDAs, non-disclosure agreements. Okay, so if you find out something, you can't tell everybody else, hey, guess what? These guys are going belly up. Now, and they go on to say in the second paragraph, there are ways around one party having confidential information and still transacting with parties who do not. One example is the big boy letter, where the buyer, who does not have the confidential information, acknowledges that it has made its own independent assessment of the risk involved, including the seller or the counterparty may possess material, non-public information regarding the issuer. Okay? So basically, they're saying there is a way that you can know something, i.e., short in this case, instead of going long, because you know something's bad, but you're still selling it to somebody else. Now, this 9fin reports that Apollo utilized credit default swaps to implement its short. As explained in the Chicago Booth Review, the financial institutions that issue CDSs are often lenders to the underlying companies and as such have significant insight into the results of the operations, balance sheet quality, and covenant. Okay? Although asymmetrical information may not always be issued in the CDS market, an NDA would likely prevent the party who signed it from buying or selling CDSs of that company's debt. So what they're saying here is that normally Apollo would not be able to do a CDS, yet they did. And this one, very interesting. I totally think you should do it, but here are the possibilities, the four things, right? Did Apollo sign the NDA, or which seems unlikely? Second, Apollo breached its NDA, which seems very unlikely. Third, the wording of the NDA may have somewhat limited, and Apollo found a loophole, which has happened before. And fourth, perhaps more likely, the unit within Apollo that placed the short was separate from the unit that had access to the non-public information. This is the infamous wall in an investment banking firm that we can't cross the wall. Everyone has to, we have to protect. I worked behind the wall for 9 years. Trust me, you have no idea what we had to go through. The important paragraph here is the last paragraph. I encourage you to read it so you understand what these people were doing. So the bottom line is the industry, the insiders, they know, okay? And they take positions, the profit, if it goes up or down. The only difference is they don't tell us. Like and follow.